What do ancient merchants, medieval explorers, Wall Street traders, and people investing on their phones all have in common? They're all investors. Today, investing can be as simple as tapping a screen. But it didn't start that way. Investing has evolved over thousands of years, shaped by trade, technology, wars, booms, crashes, and human psychology. In this video, we're going to explore where investing began, how it evolved over time, and how it became accessible to everyday people. By the end, you'll see that investing isn't just about money, it's about trust, risk, and belief in the future. Let's rewind all the way back to the beginning. Before stocks, banks, or even money, investing existed in a very basic form. Thousands of years ago, people invested by trading goods. Farmers invested seeds into the ground, hoping for a larger harvest later. Merchants invested time and resources into long trade journeys, risking storms, theft, or failure in exchange for profit. In ancient civilizations like Mesopotamia, Egypt, and Babylon, people began lending grain or silver with the expectation of being repaid more later, what we now call interest. One of the earliest written laws about investing and lending appears in the Code of Hammurabi, around 1750 BCE. It included rules about loans, interest rates, and risk. So even back then, investing was about one key idea: sacrificing something now for the chance of more later. As societies became more complex, investing became more organized. In ancient Greece, merchants would pool money together to fund sea voyages. If the ship returned safely, everyone shared the profits. If it sank, everyone shared the loss. That's one of the earliest examples of shared risk, a core idea behind modern investing. The Roman Empire took this even further. Romans created early versions of business partnerships, government contracts, shares in large enterprises. Some companies even sold ownership stakes to the public, very similar to modern stocks. However, when the Roman Empire collapsed, much of this financial system disappeared with it. During the Middle Ages, investing didn't disappear, but it slowed down. Trade continued along routes like the Silk Road, and wealthy families invested in ships, spices, and exploration. But risks were extremely high. Banks began to appear in places like Italy, especially in cities such as Florence and Venice. Powerful families like the Medici helped develop modern banking by lending money, managing currency exchange, funding governments and businesses. This period laid the groundwork for a much bigger shift that was about to happen. In the early 1600s, something revolutionary happened. The Dutch East India Company became the first company to sell shares to the public. Instead of one person funding a risky overseas expedition, thousands of investors could buy small pieces of the company. In 1602, the Amsterdam Stock Exchange opened, the world's first official stock exchange. This changed investing forever. Risk was spread out. Ordinary people could invest, businesses could raise massive amounts of capital, but it also led to the first major investing bubble, tulip mania. At one point, tulip bulbs in the Netherlands were worth more than houses. When prices collapsed, many investors lost everything. This taught a lesson we still learn today. Markets are driven by emotion as much as logic. The 1800s marked a massive turning point. The Industrial Revolution introduced railroads, factories, machines, and mass production. These projects required huge amounts of money, more than any single person could provide. So companies sold stocks to raise capital. Stock markets grew rapidly in London, New York, Paris. This era created modern corporations, long-term investing dividends. But it also came with extreme inequality, speculation, and little regulation, which led to one of the most important events in investing history. In the 1920s, investing became wildly popular in the United States. People borrowed money to buy stocks, believing prices would only go up. They were wrong. In 1929, the stock market crashed, triggering the Great Depression. Millions lost jobs, savings, and trust in the financial system. As a result, governments stepped in and introduced market regulations, investor protections, financial transparency laws. This period also popularized the idea of long-term investing, rather than short-term speculation. Investors began to realize that patience mattered. In the late 20th and early 21st centuries, investing changed again. Technology transformed everything. We saw online trading, index funds, retirement accounts, global markets, then came smartphones. Today, anyone with an internet connection can invest with very little money, instant access, global reach. Investing is no longer just for the wealthy, it's for students, creators, and everyday people. But while tools have changed, the core principles haven't. Investing is still about risk and reward, patience, and a belief in growth over time. From ancient farmers planting seeds to people investing with a tap on their phone, investing has always been about the future. The methods evolve, the technology changes, but the mindset stays the same. Understanding the history of investing helps us make better decisions today, because the market may look modern, but human behavior hasn't changed much at all. If you enjoyed this video, consider liking, subscribing, and sharing. And remember, investing isn't about getting rich quick, it's about thinking long term.